higher for longer interest rates, all because oil prices are skyrocketing through the roof. Today, I'm going to break down how oil prices are going to affect inflation, then ultimately affect interest rates. I'm your host, Tony Shah, and thanks for joining me on another episode of The Mortgage Chat. Let's talk about why oil prices have been skyrocketing through the roof. And it's all because of the war between Iran and the USA and the passage of oil tankers going in and out of a certain region that is controlled by Iran. So let me show you right now. So everybody has to understand 20% of the global oil comes from the UAE and Saudi Arabia. And for the oil tankers to come in and out, they have to go through a passage called the Strait of Hormuz, which is the map right here. As you can see on the diagram here, Saudi Arabia and UAE needs the oil tankers to go in and out through the Strait of Hormuz, which is controlled by Iran. So guess what's happening? Anyone that's trying to go in and out of that strait, Iran is going to attack it. And that's why UAE and Saudi Arabia do not want to risk moving the oil tankers in and out of that strait. No one is powerful enough to protect the oil tankers going in and out. So that's why there is a massive shortage of oil, especially in Australia right now. And that's why you're probably seeing oil jumping from $1.50 all the way up to $2.30 right now. Even for diesel, used to be $1.80 to $2 all the way up to $3 right now. There is a very good professor in America, Professor Jiang. His videos are all up here. He actually explains it very simply and in detail what is happening, how it's going to affect the end users like yourself, and ultimately interest rates. So now you know why there's a shortage of oil. So how does higher oil prices affect the economy? Well, let's break it down a little bit more. Now, before the war started, oil was around 65 USD per barrel. When the war started, oil actually shot up to $115 per barrel, which is around 33 to 35% more than what we are usually paying on a normalized market. So how does this affect everybody? It's going to affect the top level people first. That's going to need petrol, oil the most. Then it's going to flow on to the end consumers. So let's start off with the top people first. I'm talking about tradies, transports, and airline people. So let's talk about tradies for now. They're going to go to job site to job site to job site, or work items, different locations, A to B to C to D, all that. Now, because they're traveling so much, they're going to use up more petrol. And guess what's going to happen? Because petrol that used to cost them $100 a week, all of a sudden it's going to cost them like, call it $130, $135 a week. Now, because of this extra $35 they need to fork out, guess what? They can't cop that cost in their own pocket because their margin just gets trimmed too much. So what are they going to do? They're going to pass that cost onto yourself, the end users, the consumers. So, for example, what used to cost me $100 to, oh no, let's just call it fix a tap, it's going to cost me $110, $115 now, just so they can recoup the extra cost from the petrol they have to pay. Now, the biggest industry that I reckon is going to cop it the hardest is your transport industry. You know, your transport trucks such as Woolies, Coles, trucks that transport cows, sheep, horses, all the way down to taxi drivers. Why? Because they are probably one of your heaviest users on petrol. And applying the same logic as I just said for the tradies, they're not going to cop that extra cost. They're going to pass that cost on to the next users. So for example, I'm going to deliver something for Woolies, right? Which costs me per trip $1,000, for example, okay? But guess what? Now petrol's going to cost me an extra $300. I'm not going to cop that cost. I'm going to pass that cost onto Woolies, which now instead of charging them $1,000, I'm going to charge them $1,300. Therefore, my margin is not compromised and I'm still making the same amount of money because I've passed that cost onto the next user, which is Woolies, Aldi's, Coles, Kmart, Big W, everything. And I haven't even talked about, you know, your fruit shops, your fishmongers, even your butchers. How are all these food going to get transported to the shop? It's not going to get delivered to themselves. They're going to have someone deliver it to them, or they're going to drive and pick it up themselves. If it's going to cost the business people an extra 30%, they're going to pass that cost onto yourselves, the consumers, the end users. If cost of goods, everyday consumer goods are going to cost you more, guess what's going to happen to inflation? It's fucking thing is going to go up. It's not going to go down. Now, let me tell you, inflation already started going up before the oil prices shot through the roof. As of January 2026, inflation rate was actually 3.8%, which was a 0.4% increase from the month before. So what do you think is going to happen in the future 6 months? Inflation is going to increase again. Hence, we've had 2 bloody rate rises this year so far because inflation is going up. And guess what? It's going to keep on going up as long as oil prices stay at a higher level. And I can guarantee you it's going to go above $100 per barrel in the coming months. So expect inflation to increase way above the targeting band of 2 to 3%. And if the RBA feels or sees the data for inflation slowly creeping up, expect the interest rates to also creep up. So therefore now there's a double whammy. Cost of living is through the roof and interest rates is also going up. So very similar a few years ago after COVID, when the inflation rate was sitting at around 6 to 7% and RBA cash rate was sitting at around 5%. So we've already seen 2 interest rate rises and I'm expecting more interest rate rises in the future. So for all you property buyers, I'm going to tell you right now, don't be scared because what you're going to see is this is going to be a good market to buy in as long as you keep enough buffers in place. What I mean by that is a lot of your first-time investors, first-time buyers are actually quite scared to get into the market right now because more than likely they've never seen a period where inflation was going up and also interest rates going up. And guess what? The unemployment rate also shot up as well. So you got 3 double whammies that may scare a lot of your first-time buyers or first-time investors out in the market. Now, if you're smart, what I say to a lot of clients is you go in right now, you can still buy, and you're going to buy with less competition on the market. Yes, it may cost you more because of high interest rate, but guess what? You're also going to buy at a price that is suppressed and you don't have much competition where everybody is fighting for the same property. And like I say to a lot of people, as long as you have a good buffer in place where you can still maintain paying the repayments at a higher for longer interest rate for, let's call it 12 to 24 months, you'll actually be winning at the end. Now, let's just do a comparison right now. Let's just say you buy a property investment for $700,000 and you're going to borrow 80% of the value of the property. The loan is going to be interest only, and let's just say rates shot up to 6.5%, which we're accounting for another 2 rate rises. So therefore, the repayment per month is going to be around $3,033.33. So guess what? You're buying at a price where the price is stagnant. There's not much competition to drive up the prices even more because maybe you have 20, 30% of the people that were looking to buy a property all of a sudden got scared and not buying anymore. So you're buying at a flat price right here, which is quite stagnant at 700 grand. And yes, you are paying a high interest rate, but guess what? Let's just say interest rates start dropping. But what's going to happen when interest rates start dropping? You're going to have more investors coming back into the market. You're going to have more buyers fighting for the same property. And when there's a lot more competition, the prices start going up even faster. So let's just say you got scared right now because interest rates are too high. But guess what? You're going to start buying now because interest rates started dropping down to 6%. But all of a sudden, there's so much competition coming back onto the market. What used to be 700,000 all of a sudden jumped up to 800,000 in the space of 6 to 12 months when you're ready to buy. And now you're ready, you're going to buy something that's going to cost you $800,000 now. And if you're going to borrow 80% of 800,000, which is a loan of 640,000 at 6% interest only, the repayment per month is going to be $3,200. So the difference between if you were to buy a property when there was no competition in comparison to buying a property when there's a lot of competition, the repayment is going to be around $167 per month. So that's why I say to a lot of my first-time buyers, first-time investors right now, as long as you have a buffer in place, you have a safeguard, you have savings at the back end for a rainy day, you should be going in now while the market has cooled down and there's less competition fighting for that particular property. So there you have it, everybody. I hope you enjoyed this video today. Please, as always, subscribe to this channel, watch all these videos up here, follow our Instagram, follow our Facebook page, and please stay tuned for our next episode of The Mortgage Chat. Thank you, and I'll see you soon.